The world of finance, a realm traditionally governed by pinstripes and prudence, finds itself increasingly captivated, the object of its intense gaze, cryptocurrencies. These digital assets, once dismissed as niche playthings for tech enthusiasts, now command serious attention. Major US banks, the behemoths of global capital, are stirring. They hear the insistent hum of the blockchain. They see the burgeoning market capitalizations. Client interest, too, is a powerful motivator, a rising tide of inquiries that can no longer be ignored. The allure is undeniable, a potent mix of innovation and immense financial opportunity that whispers of new frontiers in an old world. It's a siren song, and the big ships are slowly turning their helms. Why would these titans of traditional finance, institutions built on centuries of established practice, even glance at such a volatile and often bewildering asset class? The answer is multifaceted, a complex tapestry woven from ambition, necessity, and perhaps a touch of fear, the fear of being left behind. Innovation waits for no one, not even the most venerable banking houses. The digital revolution is reshaping every industry, and finance is no exception. Cryptocurrencies represent a paradigm shift, a fundamental rethinking of how value can be created, stored, and transferred. To ignore this would be akin to a horse-drawn carriage business dismissing the advent of the motor car. It's about relevance in a rapidly evolving landscape. The interest manifesting within these hallowed halls is far from casual. It has moved beyond mere academic curiosity into the realm of strategic planning and internal debate. Boardrooms and executive suites are abuzz with discussions about how, not if, to engage with this new digital ecosystem. The conversations center on tangible services, providing custody for digital assets, facilitating crypto trading for institutional and high-net-worth clients, and even exploring the potential of blockchain technology to streamline existing banking operations. The initial explorations might be tentative, but the underlying intent is serious. Banks are meticulously weighing the risks against the potentially enormous rewards. This burgeoning interest is also a pragmatic response to the sheer, unignorable scale of the cryptocurrency market. What was once a rounding error in global finance has become a significant asset class in its own right. Billions, sometimes trillions of dollars flow through these digital channels. For institutions whose very business is the management and movement of capital, pretending this phenomenon doesn't exist is no longer a viable strategy. The crypto world is not just knocking on the door of traditional finance, it's started to dismantle the frame. The banks, ever watchful of where the money flows, are beginning to acknowledge that this current is too strong to simply observe from the shore. Despite the undeniable pull, the approach of US banks towards cryptocurrencies can best be described as exceedingly cautious. Think of a bomb disposal expert approaching a suspicious package. There's a clear objective, but every step is measured, deliberate, and acutely aware of the potential for things to go spectacularly wrong. Instead of grand, sweeping entrances into the crypto arena, we are witnessing a series of carefully managed pilot programs. Banks are dipping their toes, not diving headfirst. They are forging partnerships with established crypto firms, leveraging existing expertise rather than attempting to build everything from scratch in an unfamiliar domain. This is a dance, a crypto waltz, performed on a floor strewn with proverbial eggshells. This profound caution stems from a deeply ingrained institutional conservatism, and rightly so. Banks are custodians of public trust and vast sums of money. Their reputations are paramount, built over decades, even centuries, and can be irreparably damaged by a single significant misjudgment. The cryptocurrency space, for all its innovation, is still perceived as the Wild West by many in traditional finance. Volatile, largely unregulated in a comprehensive sense, and unfortunately, sometimes associated with illicit activities. The specter of regulatory blowback, hefty fines, or becoming unwittingly entangled in money laundering schemes looms large in the minds of banking executives. They are, understandably, wary of treading too boldly where rules are still being written. The initial forays, therefore, are characterized by limited exposure and a focus on the less speculative aspects of the crypto world. Custody services, for instance, where banks would securely hold digital assets on behalf of clients, are a common starting point. This is a role banks are familiar with, albeit with a new type of asset. Some are exploring offering access to Bitcoin exchange-traded funds, ETFs, or providing limited trading capabilities for their most sophisticated clients, often with stringent risk warnings and suitability checks. The idea is to learn, to gain operational experience, but to do so within tightly controlled parameters, ensuring that any potential stumbles are minor and manageable, rather than catastrophic. Moreover, there's a distinct reluctance to be the first mover, the trailblazer, who might inadvertently step on a regulatory landmine. No institution wants to become the cautionary tale for others. The memory of the 2008 financial crisis, and the intense scrutiny and regulatory overhaul that followed, is still fresh. Banks understand that venturing into a new high-risk area prematurely could invite unwanted attention and potentially punitive action from regulators who are themselves still grappling with how to oversee this burgeoning sector. It's a collective game of watching and waiting, each institution observing its peers, hesitant to stick its neck out too far until the path forward is clearer and less fraught with peril. The cautious stance of U.S. banks is not happening in a vacuum. It is profoundly influenced by the shifting sands of the regulatory environment. Recently, there have been some encouraging signals, glimmers of green light that have piqued the interest of these financial giants. For instance, the U.S. Office of the Comptroller of the Currency, OCC, has issued interpretations that pave the way for federally chartered banks to engage in certain crypto-related activities. This includes providing custody services for digital assets, participating in distributed ledger networks, and even engaging with some stablecoin activities. Furthermore, the Securities and Exchange Commission, SEC, recently took a significant step by scrapping its Staff Accounting Bulletin 121, which had made it prohibitively expensive for banks to hold crypto assets for their customers. Political winds also play a crucial role in shaping this evolving landscape. Pronouncements from high levels of government, such as President Trump's vow to be a crypto president and foster digital asset adoption, send powerful messages to the market. The appointment of new regulators perceived to be more amenable to bank involvement in cryptocurrencies has further fueled a sense of cautious optimism within the industry. These shifts suggest a potential move towards a more defined and perhaps more permissive regulatory framework, one that could allow banks to explore crypto opportunities with greater confidence. However, the overall picture remains complex, a patchwork of evolving rules and differing agency perspectives, rather than a unified, clear directive. Despite these positive developments, a significant degree of regulatory ambiguity persists, acting as a powerful brake on more aggressive crypto expansion by banks. The green lights are often accompanied by flashing amber warnings and lingering red tape. Banks are particularly concerned about the lack of crystal-clear guidelines regarding anti-money laundering, AML, and countering the financing of terrorism, CFT obligations in the context of digital assets. They seek consistent supervisory expectations across various banking and market regulators. Without this clarity, the risk of inadvertently falling foul of complex and sometimes conflicting compliance requirements remains uncomfortably high, discouraging bolder moves into more volatile or novel crypto products and services. This regulatory uncertainty is reflected in the varied pronouncements from key bank executives. On one hand, you have figures like Charles Schwab CEO Rick Wurster, who suggested in early 2025 that the regulatory traffic lights are pretty green for large firms. Schwab itself plans to offer spot crypto trading. Conversely, JPMorgan Chase CEO Jamie Dimon, a long-standing crypto skeptic, maintains his cautious stance, ruling out significant expansion even if regulations ease, citing inherent risks. Bank of America's Brian Moynihan has indicated openness to stablecoins if regulations permit, while Morgan Stanley's Ted Pick expresses a desire to work with regulators. These differing views underscore the internal deliberations and risk assessments occurring across the industry as it navigates this uncertain terrain. The paramount requirement for U.S. banks to more fully embrace the world of cryptocurrencies is the establishment of clearer, more comprehensive guidelines from government regulators. At present, the financial institutions find themselves navigating through a dense fog of uncertainty. They are essentially being asked to chart a course through uncharted waters without a reliable map or a clear view of the horizon. While some buoys have been placed by bodies like the OCC, the overall regulatory seascape remains murky. Banks, by their very nature, thrive on clarity and predictability, particularly when it comes to compliance. They need definitive rules of engagement before they can confidently deploy significant capital and resources into the digital asset space. Specific areas demanding urgent clarification include the application of existing anti-money laundering (AML) and Know Your Customer (KYC) rules to the unique characteristics of cryptocurrencies. How should banks conduct due diligence on transactions originating from unhosted wallets? What are the precise expectations for transaction monitoring on decentralized networks? Furthermore, there needs to be consistency in supervisory approaches between the Federal Reserve, the OCC, the FDIC, and market regulators like the SEC and CFTC. Differing interpretations or conflicting mandates create a compliance nightmare, making it difficult for banks to develop robust, institution-wide crypto strategies. Guidance on capital requirements for holding digital assets and the parameters for offering crypto-related financial products is also eagerly awaited. With greater regulatory certainty, the potential for banks to expand their crypto offerings is substantial. Beyond custody and basic trading, institutions are exploring the feasibility of engaging in crypto lending, a market that has seen significant growth outside the traditional banking sector. They are also considering whether they could act as market makers for digital assets, providing liquidity and facilitating more efficient price discovery. Some large banks are even in the nascent stages of discussing the issuance of a joint stablecoin, a move that could dramatically reshape the payments landscape. However, these ambitious plans remain largely on the drawing board, contingent upon receiving unambiguous green lights and a well-defined operational framework from the regulatory authorities. The future outlook for banks in the crypto space is one of tentative optimism, tinged with a healthy dose of realism. The journey towards meaningful integration will likely be incremental, not a sudden dash. As Dario DiMartino, an M&A partner at Ando Shearman, noted, the regulatory shift is encouraging, but traditional lenders are approaching crypto with caution, viewing changes as an opportunity to engage, not a free pass. Concerns around compliance, particularly AML, will persist. The involvement of banking regulators in key crypto working groups, like the one under David Sachs, is also seen as crucial for banks to play a meaningful role. For now, they continue to weigh their prospects, run small-scale pilots, and wait for the regulatory fog to lift, ready to advance when the path ahead is finally illuminated.